In this video, we'll talk about the conventional loan requirements for 2022. If you're buying a house, you want to watch this till the end, as I'll share the top 10 main things you need to know about conventional loans going forward. So let's jump right in. So conventional loans are some of the most widely used loans out there right now. If you're submitting an offer on a house and you have a conventional pre-approval, it's seen as the strongest offer. And it's also the best loan program for you long-term. And it's also the most common one. So that's why I wanted to make this video so we can go over the next steps and focus on the top 10 things you need to focus on if you're buying a house in 2022. Let's talk about the required down payment on a conventional loan. If you're a first-time home buyer, you can purchase a home with as little as 3% down. That's only for first-time home buyers. Now, if it's a husband and wife or there's two buyers on the loan application, and then one of them has to be a first-time home buyer, even though the other person might have had a house or owned a house a couple of years ago, more than 3 years ago. The first-time home buyers is 3% down. Most people will buy, if you had a loan in the past with the conventional or FHA and you're buying another primary residence, you just need to put 5% down minimum. 10% down required. Requirement kicks in when you're buying a secondary home, also known as a vacation home. And this is where a lot of people get it confused, is that they think that the secondary home is something they can invest. Well, not really. A second home is a vacation home. So if you're in Texas, for example, if you have a house for your primary residence in Harris County, let's say, and if you want to buy a house somewhere in Galveston or on Lake Conroe, then that's fine. You can use it as a secondary home with 10% down because that's something that it's a place where you'll go to take a vacation. And then the 20% down requirement kicks in when you are purchasing an investment property, which is a property that you intend to rent out to tenants and make money off of it. The misconception and the myth about the 20% down required on conventional loans comes from the fact that 20% removes your PMI, your private mortgage insurance. And mortgage insurance is something that you have to have on the loan if you're buying a house with less than 20% down, because that's extra insurance for the mortgage company, okay? If you were to default on the loan and you stop making payments on the mortgage and they had to go in, foreclose on you, go through all the fees and process and holding fees and maintenance auctions, whatnot, if there's at least 20% equity in the house, they will get the money back. If it's less than that, then there's a higher risk that they will lose money. That's why you always have mortgage insurance when you purchase a home with less than 20% down on a conventional loan. The closing costs on a conventional loan are pretty standard. I would say they're usually around 2 to 3%, and that's assuming you will pay escrows and buy down points to get a better, lower interest rate on your mortgage. Okay, so if you're buying a house with 5% down, I always say if you can have 7.5 total, that would be enough to cover your closing costs. And I'm talking about Texas because our taxes here are crazy, they're high. So if you're buying a house on a conventional, you can expect the closing cost to be around 2-3%, but that's if you have to collect all the escrows, which is money that we set aside, such as taxes and insurance, to make sure that you're covered and it's counted in your monthly payment. So including escrows and buying down your interest rate. So I would say 2-3% is a safe bet, but this is kind of worst case scenario, right? So you can get a loan with a little bit less than that. You can, for example, do 20% down and you can waive escrows. I have buyers that do that all the time, and they have the lowest, cheapest loan, right? Because if you put 20% down and then you're responsible to pay your insurance and taxes by yourself, you can waive escrows. Therefore, we have to collect less at closing, and their closing costs would be lower. I made a separate video on closing costs specifically. So if you want to check it out, I'll put a link over here on top, going in detail, in depth about the closing costs in Texas. When we talk about the credit score on a conventional loan, the absolute minimum credit score you need to have is a 620. If you have a lower credit score than that, lower than 620, you cannot get a conventional loan. And I'm talking about the mid score. So when we pull a client's application and we pull their credit report, we always use the mid score, okay? And if we have two borrowers, it's the lower mid score of the two applicants. So just keep that in mind. So 620 minimum, so 620 to 680. If you have a credit score that's higher than 680, that's when the rates get better. It's a little bit more interesting if you have, a higher credit score, because you'll get better rates. And then the top of the tier, top of the chart is 740. A lot of times I'll get a client who says, hey, I have an 800 credit score and my score is dropped to 750. You're fine. You don't have to worry about it. It's already in the lowest, you're already in the top tier, so it doesn't affect what kind of rate you would qualify. And it's always cool to have a 2-year credit history would be best on a conventional loan. When you have some events in life that affect your credit score, like credit events, they can affect how long, what is the waiting period and how long you have to wait before you can actually purchase and close on the mortgage. With a conventional loan, if you have a short sale, there's a 4 years waiting period from the transfer. If you have a foreclosure, there's a 7 years waiting period from the transfer. Now, when we look at a bankruptcy, Chapter 7, that's 4 years waiting period. Chapter 13, that's a 4 years from dismissal or 2 years discharge. What kind of interest rates do you have on conventional loans? So it depends on your credit score, your back-end ratios. There's a lot of parts, details that go into that to answer that specific question. But when we look at interest rates, if you have 3% down, the minimum requirement on a conventional loan, that rate would be a little bit higher than if you can put 5% down. And then, the conventional loans tend to be, depending on the credit score, it tend to be a little bit higher than conventional loans, but they have lower mortgage insurance. Okay, and obviously, if you're buying your primary residence, it's lowest on the primary purchase. It's a little bit higher on secondary home, vacation homes, and then the rates are the highest on investment properties, right? Because that's a purchase long term, you're going to make money off of it. So the investment properties have the highest interest rates. And I also have a video where I went in detail in breaking down how mortgage interest rates actually work. So if you want to check out the link over here, I'll put it above. You can click on that, and that'll give you an exact breakdown on when does it make sense to buy down the rate, how does it work? I mean, things like that. So check out the link over here. Mortgage insurance, that's the devil. Everybody thinks that mortgage insurance is the devil. It's not really all that bad. Mortgage insurance is in place to protect the lender. Whenever you're purchasing a home that has, and with less than 20% down, you have to have mortgage insurance. Okay, so that's an extra cost, an extra payment that's added into your monthly mortgage payment to cover the lender just in case if something were to happen and we had to foreclose, let's say the lender had to come in and foreclose on the property. So the upfront mortgage insurance, there is no upfront mortgage insurance on a conventional loan. FHA, VA, they have upfront mortgage insurance. And with mortgage insurance, as a loan officer, we can actually shop it for you. We have 6 different mortgage insurance companies that give us different quotes. So you can have one loan officer shopping for the lower MI quote for you. And that could be 20, 40, 50 bucks apart, easy. So always make sure that your loan officer is actually shopping for the mortgage insurance, because that affects your mortgage payment going forward. And on mortgage insurance, 20% equity. So when you have 20% equity in the house, you are allowed to request the removal of the mortgage insurance. It doesn't drop automatically off. A lot of clients think that, once I have 20% equity, it's going to drop off automatically. Nope, that's not how it works. Once you have 20% equity, you can reach out to the servicer, whoever has your mortgage at the time, and you can ask them to remove your mortgage insurance. You can say, hey, I think this is what the house is worth. They'll order an appraisal and you have your mortgage insurance removed. Now, if you do not reach out to them, it will drop off automatically once you have 22% equity. Okay, and they're going off of the initial original purchase price. So with the appreciation that we're seeing, obviously you don't have to wait till it kicks in with the system. You can reach out to them sooner, and you can always call your agent, reach out to your loan officer, help you close the loan. They can do an update, a CMA on the house, and once they know you have 20% equity, then they can give you some advice to reach out to the servicer and get that mortgage insurance removed. And then mortgage insurance, everybody thinks that it's so bad, it's so high. It's not that bad. A $500,000 purchase, if you have good credit, 2 borrowers, might be like 70 bucks with 10% down. It's not that bad. But if you have lower credit scores and minimum down, 3% down, 621 credit score, then your mortgage insurance obviously would be much higher because it's based on the risk. Okay, so it does change, and there's a lot of moving parts to it, but your loan officer will be able to guide you through that in detail. The appraisals on conventional loans are the easiest to get as is, meaning that the house is in pretty good shape. There's some minor details that don't affect the cost, the structure, or safety of any occupants or their homeowners. So appraisals on conventional loans are super easy for the most part, right? And the cost will vary depending on how big the house is, on the square footage, how complex the house is. If it's a custom home somewhere far out, like in the Woodlands or the Heights, and it also depends on the distance. So the further the appraiser has to go out, that will affect the price of the appraisal. And if you want to learn more about the appraisals and how the appraiser comes up with values, check out this link over here. I have an interview with Mike. He did a fantastic job. Make sure you check that out as well. The loan limits on conventional loans in 2022 are $647,200. That's the maximum loan amount on a conventional loan. If you purchase a house and the loan amount is less than that, it's all within, conventional loans. If you go above a 647,200, that puts you in the jumbo world. So it's a little bit different requirements, tighter ratios, slightly different. I have a video on that too. And you can go higher. So the 647,200 does not mean that that's the sales price. That's the actual loan amount. So you can buy a house for 800 or $1 million, as long as you can bridge that gap with the down payment, put that much money down, and the loan amount itself is under 647,200. You can go with a conventional loan. I have a lot of clients over the years that did that they were kind of borderline, but they decided to put down a little bit more. So instead of going with the convention jumbo loan, and maybe potentially have a little bit longer process, they wanted to close fast, to close in 3 weeks, and we just did the conventional loan for them, and that moved faster. So 647,200 is the conventional loan limit in 2022. Conventional loans do not have a front end ratio, but they do have a back end ratio, and it's maxed out at 49.99. Now, that doesn't mean that everybody should be going all the way to 49.99, but that's for somebody, that's the absolute maximum you can get back end ratios, and that includes your current minimum obligations on your credit cards. It does not affect your cell phone or and energy bills and things like that. It affects your minimum credit cards, the minimum payments, plus the new potential home purchase with escrows. So that includes the taxes, insurance, and HOA if you have an HOA there. So the back end ratio is 49.99, the maximum on a conventional loan. And on conventional loans, you do not have to count your spouse's debts in the ratio. And item number 10 on this list in this video are seller credits. Seller credit is when you're on the contract and you're asking the sellers to help pay for your closing costs, some of the expenses that you're occurring in the process. So seller credits, we have, as you can see over here, it depends on the type of purchase. Is it primary or investment, and the down payment? So if you're putting the minimum down like 3%, 5%, anything less than 10%, really, anything less than 10% on a conventional, the maximum seller credit, seller concessions towards your closing costs that can be used to cover your closing costs, like actual hard fees or points to buy down your interest rate or escrows. So the maximum is 3% max on a conventional with minimum down. But if you're purchasing a home and you're doing 10% down or more, that goes up to 6%. Not many people know that you can actually get 6% back seller concessions from the sellers towards your closing costs on a conventional loan, but you can. But the requirement is that you have to have 10% down or more. And then if you're purchasing an investment property, the maximum the sellers can do is only 2%. So it maxes out at 2% towards your closing costs. I hope you find this helpful. If you like it, make sure you smash that like button. Don't forget to subscribe so you don't miss any future videos like this. Thanks for watching, and I'll see you in the next video.